If you don't know how to read a chart, you don't understand the market. Most beginners look at the price, but they don't understand what's actually happening. They see movement, but they don't see the logic behind it. As a result, random entries, emotions, and losses. But the good news is that the basic understanding of a chart isn't as complicated as it seems. Let's break down the foundation you actually need to get started. Let's begin with the simplest element, candles. A candle is the foundation of any chart. Each candle shows how the price moved over a specific period of time. It can be 1 minute, 5 minutes, an hour, or a day, depending on the time frame you choose. A candle has a body and shadows, which are often called wicks. The body shows the difference between the opening and closing price. If the price closes higher than it opened, the candle is green. This means buyers were in control. If the price closes lower than it opened, the candle is red. This means sellers were stronger. But what many people miss is the most important part, the wicks. Wicks show where the price tried to go but couldn't hold. This reflects the battle between buyers and sellers. For example, a long upper wick may indicate that the price tried to go higher, but sellers pushed it back down. A long lower wick shows that buyers stepped in and pushed the price back up. The longer the wick, the stronger the reaction. When you start paying attention to candles, you stop seeing just price. You start seeing the behavior of market participants. Now let's move on to the next key element, the trend. The trend is the direction of the market. And this is one of the most important concepts to understand. The market doesn't move randomly. Most of the time, it moves either up, down, or sideways. If the price is making higher highs and higher lows, that's an uptrend. It means buyers are in control. If the price is making lower highs and lower lows, that's a downtrend. In this case, sellers dominate. There's also a third scenario, a range or sideways market. This is when the price moves within a zone without a clear direction. One of the most common mistakes beginners make is trading against the trend. They see that the price has gone too high and start selling. Or they buy in a falling market thinking it can't go any lower. But the market doesn't owe anyone anything. So here's a simple rule. Trade with the trend. It significantly increases your chances of success. Now let's add another important element, levels. Support and resistance. Levels are zones where the price often reacts. Support is a level where the price tends to stop falling. Demand appears there, and the price may start moving up. Resistance is a level where the price tends to stop rising. Supply appears there, and the price may start moving down. It's important to understand that these are not exact lines. They are zones. Price can slightly break them, come back, and test them again. Why do levels work? Because a large number of market participants are focused on these areas. Orders are placed there and decisions are made there. Often the price reaches a level, reacts, and then comes back to test it again. Sometimes a level gets broken, and then something interesting happens. Previous resistance can turn into support, and support can turn into resistance. This is called a role reversal. When you start seeing levels, you begin to understand where the price might stop or reverse. Now the most important part, how to use everything together. Candles, trend, and levels are useful on their own, but the real power comes when you combine them. For example, imagine you have an uptrend. The price pulls back and approaches a tedious support level. At that moment, you see a candle with a long lower wick. It means the price tested the level Sellers tried to push it lower, but buyers stepped in and pushed it back up. This could be a potential signal to buy. And the opposite is also true. If you have a downtrend, the price approaches resistance, and you see a candle with a long upper wick, that could be a signal to sell. You start reading context instead of just looking at price. It's also important to understand the strength of movement. If the price approaches a level slowly, there's a higher chance the level will hold. But if the price moves toward a level with strong momentum, there's a higher chance it will break through. Context is everything. Now let's talk a bit about time frames. The same situation can look completely different on different time frames. Lower time frames have more noise. There are more false movements. Higher time frames tend to show cleaner and more meaningful trends. That's why it's important not to focus on just one time frame. Try to see the bigger picture. For example, you can identify the main trend on a higher time frame and look for entries on a lower one.